All right, so March 4th, not a whole lot of new things to talk about, except to those of you that are new and listening to this for the first time. What we want to do is spend a few minutes looking at what's happening in the market and trying to gain a little bit of clarity from all the noise. When you're looking at a chart, things are much simpler because they're very objective. When we do those things, we can maximize our time and we can really uh, make a good decision that's unemotional and move on about our day. So we talked about this quote last year, and I think it's important to talk about it again this year, which is that bull markets are born on pessimism. They never start on optimism. That's what you would find at the end of a bull market. So um, in the grains, I don't know. We've got a lot of action we're going to look at on the charts here in just a second that tell us that we may be headed for a period of a little bit higher prices. So let's talk about what may cause that to happen. So if you read the news, there's not a whole lot of new grain specific news. There's really these 5 points that you can look at, and I'm not going to dive deep into them because y'all are reading them all the time anyway. You got extreme volatility in the equity markets that's caused by the coronavirus, right? I don't think that this is a zombie apocalypse type fear where everyone thinks they're going to die from the coronavirus. I think it's just a fear of people are going to stop spending money type of issue, which is why the Fed cut interest rates again. And it's all an encouragement to go ahead and spend, spend, spend. I'm reading a lot of cattle guys that are getting really nervous, the cattle market, because if people stop spending, then high end steaks are going to be one of the first places that they start cutting, which would be bearish to the cattle market. So there's lots of guys that are more nervous about that, but at the same time, to the grain market, there's less fear there because we turn grain into cereal, we turn it into other types of protein that are cheaper. So the general feel is that the virus isn't as bearish the grains at this point as it maybe was. And there are now rumors that China is in the market starting to kick tires, looking to buy wheat, corn, soybeans, and Milo. I do know of several Milo trains that have traded in the last few weeks, or the last 10 days. We'll see if that continues and if that materializes. Certainly, the dollar has been selling off, which is great for us as we become more competitive. And then you're starting to hear the weather talk, right? Of as we get planters rolling in the south, and you start putting this 2020 crop in the ground. You're starting to hear weathers of talk of saturation and flooding and snowmelt, and we're even starting to hear some uh, uh, La Nina and El Nino talk about what may happen in there. All those things point to more volatility in the grain markets, which is where we should be. So with that, I'm going to jump straight to the charts because that's where we need to be spending time anyway. All right, here's May's soybeans. Get crosshairs on here so you can follow with me. May beans are carrying a little bit of a bullish tilt. We talked about this last Wednesday, this bullish divergence. Remember, a divergence is when you have a move, successive lower lows with lower highs, when the indicators fail to make corresponding lows. You've got a perfect divergence set up right here off of this low, and that has been in play now for 3 or 4 days. Um, it, we got to get above this 910 level and hold it in order for beans to be able to work much higher. If we can break this 910 level, then we should move on to 916 to 930. That is the next kind of area of resistance that could have some issues getting through. I think to get above 930, you got to have confirmation of China purchases. That's just kind of my sense. That has nothing to do with anything other than my own opinion, but that's what the market feels like. So we'll see what happens. Likewise, if we don't have confirmation, if they're not buying, and headlines get worse, then at this 916, 925, 930 level, we could turn into some weakness. You also see the bottom of the cloud right up at that same level over the next few days. So we could trade up to it, and then you expect chop before you can get up out of that cloud and really start to move higher. So we're not bearish, we're not crazy bullish beans from here off of this setup, but we're definitely not overly bearish either, because with this setup, this should be a low that holds for quite a while. Something's got to fall apart, I think, for that to really be able to slide lower. So we're trading exactly where we were 26 days ago. We've got we're below our cloud, but we've got this bullish divergence that's trying to work us a little bit higher. So we'll just have to let it unfold and see what happens. And if we can't break 910, then I think we're range bound between 910 and 880 until further notice. So if anybody wants to do a chant and cheer for 910 to be broken, you know, be my guest. All right, let's look at corn. Corn's had a busy week, right? For the last several days, corn has broken out the downside of its wedge and now traded back up inside it. So, and we've talked about this a lot for the last several weeks, where this wedge that started in September was finally broken last week by the corn market, and we took out the low from the prior September low here. We took it out on this day, and we went with it. We had written extensively that we were going to go with that move, and we were gonna be short. So recommendation was to leave hedges in place and to be short moving out. That changed right here with this 9 and this reversal right here, strongly indicated that we might see a reversion back to the bottom of this wedge to test the bottom side of it. We did that yesterday. We broke it. We closed inside it. And so far today, we've held it. So today's close is really important for the corn market. It's really important that this 79 level holds. If it falls, then we should pretty quickly test 375. And if that falls, then you know, I think it's bon voyage for a little while for the corn market, because that would be a test, a failure, and then successive weakness. If it holds, then the top of that wedge is right here. Excuse me. So look at what's happening right in this area. This is 388 to 386. There's a lot happening right here technically. First of all, you've got the bottom of your cloud. Second of all, you've got this point of reversal where the past move lowered. That's this dotted line right here. So you've got these 2 points that are very important to get above. And if that's not enough, that's the top end of all of this massive resistance level that we stayed in for about 3 weeks, just 10 days ago. So that's an awful lot of price action that corn's got to overcome in order to get out, and it's the top of the wedge. So you've got a lot happening right here at this 87 to 89 level, where if corn can break it and hold, then you should expect the same kind of thing to happen. It should pull away from it, probably test it again, so we'd work higher, then we'd test it again, and then the market's gotta really make a statement about whether it's gonna implode or whether that's gonna become a long-term support. So the next 6 to 10 days are really critical for the corn market to decide which way it can go. So for weeks we've said inside this wedge is a 50-50 loose ball. We broke to the downside. That's now false. It's now 50-50 again, with a lot of stuff happening right up above here. So corn's really got some work to do to get above it, and I won't hammer on that any more than I need to. Let's look at the corn bean spread, see what it's doing, and it is actually neutral. It's not doing anything new in relation to that spread. So neither beans are not buying acres, corn is not giving acres up. It's kind of interesting that with almost a 3 billion bushel carryout problem, corn's not really trying to give up acres, and with a carryout decrease in beans, it's not really trying to buy acres. So it's an interesting phenomenon. Maybe that's being caused by coronavirus. I have no idea. But keep an eye on this spread, because over the next few weeks, that should move some way in order to help decide which direction it should go. All right, let's look at Kansas City wheat. It's not performed well here the last few weeks. We're below our cloud. We're solidly in a little downtrend here. We do have this reversal that worked. This was Wednesday, Tuesday, Monday. This was Friday, with follow through the last 2 days. Today we're seeing if we can't break the bottom side of it. It's going to be important for this to hold these levels right in here. Otherwise, we could continue to work a little bit lower. There's no divergences. There's no signs of this move being over, other than this reversal, which is a good sign. We need to work higher and really get back above 470, which is the bottom of the cloud, and also the bottom end of all this support that goes all the way back to December 17th. So you got this low, you got all these lows right here that held all the way through this time period, and you can see when we broke them, it just imploded. So as wheat trades, we traded yesterday right to the bottom of it and failed. We'll see if we can't get another run at it today. Watch corn, because if corn moves, then wheat is more than likely going to go with it, because here's your corn wheat spread. We've talked about this a lot. We were really bullish this spread back here in October, which made us very bullish wheat. It now has reverted to its normal, which is a slight premium to corn. This is Kansas City wheat to corn. So Kansas City wheat minus corn historically trades at about $1 premium to corn. We've had this move off of this high, and we're now getting a divergence off of the high on the wheat corn spread. So watch corn, because if it moves higher or holds its ground, that should gravitate to being a little bullish wheat. It's not as bullish of a signal as this stuff was back in here, where we were just incredibly discounted, but it really could provide some support. So wheat's relationship to Chicago is important too, because it's still at historic near all-time lows. Kansas City's never been cheaper relative to Chicago than it has been recently. So Kansas City still undervalued Chicago. It's borderline undervalued against corn. And so I think it all comes down to king corn, and is that wedge going to move us? Are we going to move to the top side of that wedge, or are we going to break back out the bottom of it? We're right back to where we've been, 50-50, and we will see what happens. So, watch the headlines. We're probably going to be pretty responsive to headlines as they come out, but a break will tell us what to do when it happens. All right, that is what I've got for you this morning. I hope that that's a little bit helpful. If you're, hold on, one thing, we got to go back and look at Program Tracker to see what we did there. We took one action. We bought May soybeans at $8.96 last week. We bought them on, I can't remember, Thursday or Friday. We didn't take any action in wheat or corn, which puts us since February 1st positive just a little bit. These spreads are really starting to come in and work and define themselves. So stay tuned, because as these things work away from their equilibriums, these results are going to become pretty impressive. But in an extremely volatile week with very unpredictable programs or very unpredictable price swings and being pulled around by equities, really grain markets held up pretty well. I think they're maybe the bright spot in all things. So with that, that's all I've got for you. I hope it was helpful. If you have questions, please call us, and we will talk to you next week.